How from the film Babu Rao would always be like कि मेरे को तो बिल्कुल risk नहीं चाहिए, to always being convinced by Raju and investing his entire savings or investments or money that they made into random schemes where it would get double in 1 month, like 25 din paisa double. So contradictory, right? Like when we watch the film, we laugh over Babu Rao and be like, how stupid, abhi to bol raha tha no risk, and abhi only he's taken so much risk. And we think, who would do that? Until we ourselves end up becoming Babu Raos of our own investment journeys and start investing in random products without realizing their risk. Are you telling me that you've not done something what Babu Rao would do with your money? Let's find out. Namaste, I'm Akriti Agarwal from Wealth Café, where we help you make smarter money decisions. And in today's video, we are going to break the myth that just because a particular investment is giving you fixed returns, it means that it is risk-free. A lot of times what happens is that the moment we hear fixed returns, guaranteed returns, assured returns, we feel कि ऐसे कैसे कोई झूठ बोल सकता है. This is a good investment and I should invest in it right away. Because who doesn't want fixed 12% returns, 10% returns? And in fact, if on top of all these things, if these investments are promoted by so-called influencers on social media, we are like, ABC person ने बोला है तो सही बोला होगा, I should invest in it. And then until it's too late, or it could be too late, we fall for the trap. To help you understand, one of this example is DHFL. Until a few years ago, DHFL fixed deposits or NSDs would give you a return of 9 to 10% fixed, and that was one of the best products in the market. A lot of people invested in it. In fact, it was a AAA rated bond. So from the rating perspective also, it fit into the category. Until news started coming out and DHFL started defaulting on their interest payments, and ultimately people ended up losing almost 60% of their investment amount. Yes, it's not like they earned lower interest, but the risk in this investment was also the fact that you can lose out your entire capital. And that is exactly what happened with people who had invested in DHFL. Now, let's understand the risk that I'm talking about. The risk when you make an investment is not that you may make lower returns or zero returns, but also the fact that you can lose out on your entire capital. And this risk is prevalent not just in equity, but also in these fixed assured return products that we see now popping up everywhere around us, right? So the first thing that you need to understand is that most of the bonds work on unsecured loans. There is no one who's securing you, right? Most of them could not be secured by the government, RBI or SEBI. So it's very, very important to understand if the product that you're invested in is regulated by someone, and if tomorrow the company goes bust, which authority would you go and complain or would ensure that you receive the money? In fact, mutual funds are highly regulated by SEBI, which ensures that the investor's protection is taken care of first. The second thing, when we invest in fixed deposits, we get a DICGC insurance. By fixed deposit, I mean by nationalized bank, and that kind of protects us up to 5 lakh rupees. But it's not like the other bonds and other fixed products in the market today have that security. So you must check that. And the third and the most important rule of investing is high risk, high returns, low risk, low returns. So the moment your return starts increasing even by 1%, the risk in that product starts increasing. And it's not like these two are proportional. You need to understand, for that 1% increment return in the name of fixed asset, how much risk are you taking? Are you taking a little risk, or are you taking the risk where you may lose out on the entire investment amount? These are the kind of research that you must do when you invest in fixed assets. So let's understand, if I have to put most of these fixed asset products on a Riskometer, how would they rate? Obviously, the first one is our sovereign products, giving us a little return of 5.5%, but comes with government guarantee, and we know that they are risk-free. The second one on the list is fixed deposits. giving 6% return now, but are backed by DICGC up to 5 lakh rupees. And because the banks have a good standing, forms the pace of economy of our country, we get good returns. But ensure that when you are investing in banks, don't go for cooperative banks. I'm sure everyone knows about the PMC scandal, right? So stay away from cooperative banks. Again, for that 1% incremental risk in cooperative banks, you're taking a huge risk of the entire capital loss. Now, after these two, the third one is corporate deposits, where NBFCs issues deposits. They have a good credit rating, but along with the credit rating in these deposits, do check their history and the management and how the company is performing in general. Do check what kind of loans these companies give. If they give too risky loans, then you know that your investment is also in risky products. So you must check that to the extent possible. Next one is Vint Wealth, a new interesting product in the market which is promoted highly by a lot of people, but please understand that it is a very, very risky product. Currently, yes, they've not defaulted, but that doesn't mean that the risk is not there. It falls under the classic rule with a high returns, your risk has also increased. So please be aware of the risk and then invest in these. Don't put your investments that you would need for emergency fund and urgent goals into this product. The next one, FDs against crypto. I mean, I don't even have to explain this, that why the risk of this investment is so high. The underlying is such a volatile product that how that product can give you fixed assured returns. I mean, it's beyond me that how would someone believe that this is a risk-free investment, right? So the whole idea is that as the return on these investments increases, the risk also increases. So please be careful. Don't fall for that 1 or 2% extra return, but do your research, understand the risk of investing in these products, and only then invest your money. So here I'm trying to break the myth that just because a particular investment is giving you fixed assured returns does not mean that it is risk-free. And in the end, please understand that, when we are trying to jump off a cliff, right? Or when we're driving a car, we understand the risk, and that's why we always protect ourselves. But when we are investing in financial markets, we can't see the risk until it's too late. And that is why we take risk more than what we can bear. So someone with experience will understand that how risky investments can be. So it's good to manage them right. It's good to talk to your advisor or people who can help you how to invest in these products by understanding your risk and the risk of the goals, and of course the product. So if you want us to help you with the same and help you invest basis your risk profile and create wealth, then do reach out to us at iplan@wealthcafe.in. And yes, do share this video with someone who was struggling to understand these products risk and was blindly going, अरे 2% extra return है, invest कर लेते हैं, अच्छा होगा. Please be careful, be safe, and we shall see you soon with the next video helping you to improve your finances.